Hello and welcome to Livewire Markets. My name is Chris Conway. On today's Views from the Top, I'm sitting down with Jonathan Bailey, who's the Global Head of ESG and Impact Investing at Neuberger Berman. Jonathan, thanks so much for joining us today.
Chris, it's lovely to be here. Thank you for having me.
Of course. For those who aren't familiar, can you just share a little bit about your investment philosophy and main areas of interest?
Absolutely. So Neuberger Berman manages just over $450 billion US dollars across public and private markets, fixed income, public equities, private equity, and so on. And our belief is that there are financially material, environmental, social, and governance factors that are an important part of investment processes across the different asset classes. But also, for some clients, there are sustainability and impact objectives that we can express in portfolios, whether in public or private markets, that are going to create opportunities for good investment returns around big secular trends like the climate transition, health outcomes, and education. And so we try and express that in portfolios for clients.
Jonathan, I note, looking back at your experience, you've got some familiarity working on sustainability and governance projects with governments and some fairly significant people. What are the main differences in the approach between governments and asset managers, and what could they learn from each other?
Well, the first thing is to make sure as an asset manager that you don't think you're a government and
Sure.
that you don't try and take on policy objectives. That's the role of democratically elected officials. But there are obviously some of the big challenges that the world faces, whether it's around climate change, whether it's around equity, inclusion, and diversity, where there's a role for both the private sector and for the public sector. And in both cases, having an evidence base, having metrics, being accountable for those outcomes is really important. And so often when we look at working with clients, they may say, look, I'm looking at the climate transition. There'll be investment opportunities that the private sector can mobilize capital at scale and can use the power of capitalism to be able to create a self-fulfilling set of opportunities, whether that's taking a technology like battery storage to scale, or whether it's about deploying rooftop solar. But there's also going to be a need at times for government to play a role to fill gaps that the private sector can't. So in some markets that might be about carbon capture and sequestration and providing subsidies for that, or it might be in other markets where nuclear is considered to be an appropriate part of the fuel mix. So it's really important that the public sector thinks about where it can make a unique value add that can't be solved with market solutions, and that the private market does what it does best, which is to efficiently allocate capital to returns that also happen to be aligned with those sustainability objectives.
Jonathan, as I understand it, and please correct me if I'm wrong, but there's no universal standard when it comes to ESG. Not in the way that, say, we have the international accounting standards, of course, which govern accounting. So how does that create challenges, and how do you address those challenges when you're looking at these investment opportunities?
I mean, the first thing is that it can create confusion for end clients. What's really important is that when you're investing in a particular investment strategy or product, that you know whether it's a product that is only considering financially material environmental and social and governance factors in order to achieve a financial objective. So, for example, if you're going to buy an automotive manufacturing stock, you want to know about their EV plans, because at some point that's going to be an important part of the products that are being sold in key markets. But that's purely from a financial perspective. Secondly, though, if you're an investor who wants a sustainability outcome, you might want to only invest in pure play EV manufacturers because of a climate objective that you have. So being clear about what the investment product is doing and standards around terminology is really important. And we've seen some regulators in some markets begin to put definitions around that. So if the fund has the word sustainable or impact in the name, that has to mean certain things. But that's still evolving, still emerging. There's not a global consensus, as you say, around that. And one of the things that we do at Neuberger is to make sure that we have very clear disclosure in our documentation, and that we work with regulators to try and encourage them to put in place transparent frameworks.
Jonathan, we've seen some data recently out of the US and Australia that passive investing has overtaken active investing in terms of volume. You co-authored a white paper, I just want to make sure I get the title right, The Limitations of Passive Investing to Achieve a Net Zero Outcome. What are those limitations, and how do you propose we come up with solutions to make sure that we do meet those net zero targets?
Look, passive investing, is very good if you've got backwards-looking data where there's no real debate and that you can build an index around it. So if you want a portfolio that is based on value stocks, and you've got a consensus around what value looks like, for example, price to earnings ratio, then you can build a passive index to do that. The problem with something like net zero or the climate transition is it is by definition forward-looking. It's about a transition to something in the future. And there is not an off-the-shelf data point that can predict that perfectly. So in our view, a lot of the investors who are looking to align a portfolio with the climate transition need to be looking at forward-looking metrics and ultimately judgment from equity research analysts, credit analysts, who can tell you something about the capital allocation plans, the business strategy, and the management credibility of evolving a company towards net zero. And obviously that's very hard to do in a passive product. And so, our view is that that's better done with active strategies, whether, in equities or elsewhere.
Neuberger Berman, very active around voting initiatives, trying to influence companies to positively impact corporate behaviours and the like. Can you provide some examples of when you've had successes with that engagement?
Yeah, one of the things that's really important is, most investors vote. But voting is not, an activity that's an end in its own right. It's about being able to use voting to achieve outcomes for clients. And so, one example that we've put in place is an initiative called NB Votes. And what we do is we pre-disclose ahead of the annual meeting how we're going to vote at key meetings and provide an explanation of why. So we'll be able to contrast two companies, one where perhaps we're supporting the compensation plan and another where we're opposing it, and explain the nuances as to why one is well structured and we think is going to create long-term value, and another one is perhaps excessive or not aligned with long-term value creation. And what's great is that by being transparent and upfront, it's an escalation mechanism in our engagement with the companies. Mm-hmm. So often we'll be engaging privately, through meetings with the executive team or the board. And if we're not seeing traction, then we can go public, and that often creates that additional bit of leverage to be able to push the company in the right direction. And so a good example of this from our recent MB Vote season in 2023 is the retailer Costco, who we were able to come out publicly in support of because of the progress they'd made around climate change, taking board oversight of climate risk and improving their disclosure and target setting practices. In 2022, we've been public in opposing them, voting for shareholder proposals calling for reform because of a lack of action. And it was great to be able to see that that improvement had happened over the course of that year, and that our MB Votes initiative had been public in calling for that and then helping to deliver that change.
Jonathan, just a follow-up question there, if I may. How receptive are companies, generally speaking, when you approach them that first time? You provided the example there with Costco.
Yeah.
Perhaps initially, it took some time for them to respond. So are they usually receptive, the companies that you approach?
Look, sometimes there are reasons why the company's not. They might have a dual share structure, or they might have a control investor. We've been public in the MB Votes initiative at companies like that, and sometimes it can take time. Another example is Netflix. We were public in calling for them to evolve their shareholder rights structure for many years. Frankly, the company was not responsive, even when there was majority support for shareholder proposals calling on it. But we did see some improvement actually in 2022, and they did adopt some of those reforms belatedly. So sometimes it's just about being persistent and clear and making sure you're explaining, why, and that can lead to a breakthrough. But of course, sometimes you have to escalate even further. And so in 2023, we actually filed a shareholder proposal at a company called Lionsgate, a film and entertainment company, calling through that proposal for the boards to consider removing a dual share structure and equalizing rights, which actually gained majority support from shareholders. So that is a step that we are willing to take at times that, frankly, a lot of asset managers are not willing to do. And I think it's important that if you're going to be an engaged owner focused on outcomes, that you're willing to use all the tools in the toolbox.
Jonathan, interest rates have been elevated, and it makes long-term cash flows worth less today than they used to be, indeed a couple of years ago. So how should investors be thinking about investing in climate?
Yeah, look, if you go back to sort of the COVID period, with a lot of sort of more speculative companies coming through to markets, using SPACs and other things without sort of a lot of free cash flow being generated in the short term, we've seen a lot of those stocks struggle in the period since. And there are technologies like solar and onshore wind that we absolutely believe are going to be and are competitive, but that doesn't mean that specific business models are resilient to a change or volatility in interest rates. And so it's really important as an investor that you're looking at the ability of a company to self-finance during these difficult periods, to generate free cash flow that they can reinvest in their business, and they've got strong balance sheets and the ability to sustain periods of elevated borrowing costs. So that might mean that you need to look at slightly different business models that are more mature, but are still avoiding emissions. So we see great opportunities in industrials. We see opportunities in the EV supply chains with diversification of end risk of different OEMs. And we also see opportunities in supporting the growing demand for data centers and generative AI with things like efficient cooling and also in electricity generation from mature utilities that have robust balance sheets, as I said.
Jonathan, some of the problems around ESG could be argued as a lack of understanding. There's lots of focus on the E and not so much on the S and G at times. But what are some of the other governance issues that you come across that can have particularly damaging impacts on companies?
Look, ultimately, as an investor in public markets, you're almost always a minority. You're almost always, having to have the board act in the best interest of all shareholders. And so it's really important that you've got the right skills and a diverse range of perspectives and expertise on that board. And you think about some of the disruptions that are happening right now, and I mentioned, generative AI earlier. That's a great example of, is there the right understanding of how business models are going to be evolved, and our management team's being asked about that, because ultimately as a shareholder you vote on maybe the nomination of directors, the compensation plan. You don't vote on business strategy, right? You need the board to be asking the tough questions, to be challenging the executive team, and to be weighing in on those key capital allocation decisions to make sure that they're creating long-term value. And so having the right people on the board with the right expertise and disclosing your process for picking those individuals to make sure that they're rounding out that perspective is really important. So it sounds basic, but yet we still see boards that don't refresh themselves, that don't have diverse perspectives, and ultimately then aren't able to fulfill their obligations.
Jonathan, let's focus on the positive now. You spoke about some of the things that you're paying attention to at the moment, but I really want to hone in on the most exciting opportunities. So where are you directing most of your capital and your time at the moment?
Look, the climate transition is this mega trend. It's a fascinating opportunity for active investors. And one of the things that clients often ask us is, how do I know if it's accelerating or decelerating? How do I know where my portfolio is positioned, and how do I take advantage of that? And so that's why we've done a whole bunch of work to be able to create a net zero alignment indicator, which evaluates companies across markets in terms of their preparedness for the climate transition, looking at things like the robustness of their business strategy, how their capital allocation is or is not aligned with the transition, and understanding how they think they're going to create value as they move through the transition themselves. And so that alignment indicator creates huge opportunities to create investment solutions for clients that can help them achieve their net zero objectives with a real bottom-up understanding of which business models are likely to be successful. And this is so exciting because there's areas like cement, steel, chemicals, fertilizer, transportation, where it isn't simply a case of sort of divesting your way to an outcome. We're going to need steel and cement and fertilizers, but it's about finding those companies that are being thoughtful and long-term and are investing their precious capital in the solutions and the evolution of their business model to take advantage of the changes that are happening around us.
Jonathan, today's interview is called Views from the Top. What is the one thing that you've learnt in your 7 years at Neuberger Berman managing the ESG department?
Look, I think the main thing is that change is constant, and when I started this job, very few people knew what ESG was as an acronym. Now a lot of people know what ESG is, or at least they think they know what it is, and they have an opinion about it. And one of the things that's been so amazing about the journey that I've had has been the constant opportunity to learn and to engage with a wider and wider set of clients and stakeholders around what ESG can do for them in their portfolios. And so I think being open to that and challenging yourself, never to be complacent, but to understand how you can continue to learn and evolve your approach, keeps it fresh, keeps it interesting, and ultimately, makes it very rewarding.
Jonathan, thanks so much for sharing your insights with Livewire. We appreciate it.
Lovely to be here. Thank you.
If you enjoyed that Views from the Top as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.